Walk through Wall Street today or scroll through the news on your phone and you will see a picture of success. The stock market is at record highs. Tech companies are promising that artificial intelligence will solve every single problem. And politicians are passing bills with names like the Big Beautiful Bill, promising tax cuts and money for everyone, forever. It feels like a golden age. But history whispers a warning to those who listen. In 1929, just days before the Great Depression began, the smartest money experts in the world said stocks had reached a permanently high plateau. In 2000, they said that the internet changed all the rules of making money. In 2007, they said real estate never falls. Every single time, the dream was shattered by the reality of math. So today we're standing at the same cliff, and this time the crash might be arriving in 2026. The question is, will you be ready and will you act accordingly? By the way, I'm not a financial advisor and this is for entertaining purposes only. The warnings of an upcoming major crash in 2026 are not just stated by me, but also JP Morgan and other big banks, so pay attention. Let's jump in. The global financial system at the end of 2025 is being held up by three temporary pillars. Think of them like wooden beams holding up a crumbling building. The first pillar is government spending. Politicians keep giving away money that they don't have. The second pillar is AI hype. Everyone believes artificial intelligence will make companies rich beyond imagination. And then the third pillar is consumer debt. Regular people keep borrowing money to buy things they can't afford. These three pillars are only some of the things keeping the economy from collapsing right now. But here's the problem. All three pillars are set to break around 2026. This isn't a theory and this isn't a guess. The math looks to be already locked in. The debts are already scheduled to come due, and the bills are already waiting to be paid. 2026 is what they call the maturity wall. It's the year where trillions of dollars borrowed when money was free come due in a world where money is expensive. Let me show you exactly why this is going to be much worse than anyone is telling you. Let's start with the government. In July 2025, Congress passed something called the Big Beautiful Bill. It sounds great, right? It extended tax cuts and it increased the standard deduction. It eliminated taxes on tips. On paper, it looks like a boom. It puts cash in your pocket. But there's a hidden cost that nobody's talking about. This bill adds around an estimated $4.1 trillion to the deficit over the next 10 years. That's trillion with a T. It dumps massive amounts of money into an economy that already is struggling with high prices. Economists call this fiscal reflation. What that means in simple English is, just as inflation was cooling down, the government poured gasoline on the fire. This forces the Federal Reserve into a corner. They can't lower interest rates if inflation surges back to 4%. They might even have to raise them higher. And here's why that matters. When interest rates stay high, everything else breaks. Companies can't afford their debt and people can't afford their mortgages. The whole system starts to crack. The government just made the problem worse to win votes. And we're going to pay the price in 2026. Here's pillar number 2, which is the corporate debt bomb. This is the maturity wall everyone on Wall Street is whispering, but nobody really wants to say it out loud. During the pandemic and years after, companies borrowed trillions of dollars at near zero interest rates. They used that money to buy back their own stock and build empires. But corporate bonds have a lifespan. They expire. And for a massive chunk of the global economy, that expiration date is 2026. Here's the number that should terrify you. 38, roughly, % of all global corporate bond debt is set to mature in the next 3 years, most of it in 2026. Think about what that means. A company that borrowed money at 2% interest now has to refinance the same debt at 5%, 6%, or even 7% interest. This will double or triple their interest payments. Money that should go to profits or worker salaries will instead go straight to the bank. For what they call zombie companies, firms that barely make enough money to pay their interest as it is, this is a death sentence. They won't survive the refinancing. And when these companies start to fail, they won't fail quietly. They will lay off workers and they will default on loans. They drag other companies down with them. The maturity wall is real, guys. The debt is already owed and the calendar seems to be set. There is no way around it. Here is pillar number 3 and one of the most dangerous ones. The AI bubble. For 2 years, the stock market has been carried on the back of artificial intelligence hype. Nvidia, Microsoft, Google, Oracle, they've spent hundreds of billions of dollars on computer chips and data centers, all betting on AI. The stock prices of these companies have shot to the moon based on one assumption. AI will make them rich beyond imagination. But 2026 is projected to be the year of reckoning. Investors are starting to ask a simple question. Where is the return on investment? If these massive spending sprees don't result in massive new money coming in 2026, the market will realize it priced in perfection and got reality instead. Let me put this in simple terms. Imagine you spent $100,000 renovating your house because you were sure it would double in value. But then the appraisal comes back and it's only worth $20,000 more. You just lost a fortune. That is what is about to happen with AI stocks. A reevaluation of the tech sector won't just be a small dip. It'll be a systematic shock that crashes the entire market. Because right now, 7 tech companies make up almost all the gains of the S&P 500. If they fall, everything will follow. Here's something that will cause even more disaster, and it's the margin debt bomb. If the fundamentals are bad, the market structure is even worse. We are seeing a signal that has to come before every major crash in the last century, and it's called margin debt. Margin debt is money investors borrow from their brokers to buy stock. It's the ultimate expression of greed. It works great on the way up because it multiplies your gains. But on the way down, it works like gravity. It'll crush you. As of November 2025, margin debt in the United States hit a record of $1.2 trillion, or somewhere around there. But the raw number isn't the scariest part. It's how fast it's growing. Margin debt has been growing more than twice as fast as the S&P 500 itself. We saw the same pattern in 1929. We saw it in 2000 during the dot-com bubble, and we saw it in 2007 before the financial crisis. The current level of margin debt represents 3.6% of United States GDP. In 2000, at the peak of the biggest tech bubble in history, it was only around 2.6%. We are more leveraged now than we were during the dot-com crash. And here's how the crash will happen. It's not a straight line down. It's what they call a margin cascade. The market drops a little, maybe because of bad news or inflation, and traders who borrowed money get a margin call from their broker. They have to put up cash immediately or sell their stock. So they sell stock. This pushes price even lower. This triggers more margin calls for other traders. They sell. Prices drop more. Again and again and again. And the computer algorithms start kicking in because the selling becomes automatic and liquidity disappears. Within days, a small correction becomes a total crash. And because investors are already all in, there's a record negative around $800 billion in cash on the sidelines. There's no money to buy the dip. Everyone is already fully invested. Okay, now stick around because this next piece will reveal even something greater happening behind the scenes. And it's the real estate crisis nobody wants to really talk about. While the stock market is over-leveraged, the real estate market seems to be even more broken. We're facing a crisis in commercial real estate that makes 2008 look manageable. The shift to working from home wasn't temporary, it was permanent. National office vacancy rates have climbed to over 14%, or somewhere there, and in cities like San Francisco, it's over 22%. Empty offices don't pay rent, but the landlords still have to pay the mortgage on those buildings. And here's where it gets scary. In 2026 alone, more than $1 trillion in commercial real estate loans are scheduled to mature. These loans were taken out when interest rates were low. Now building owners face a 75% to 100% jump in their monthly debt payments if they refinance. But here's the problem. Banks don't want to refinance empty buildings. This creates what they call a doom loop for regional banks. Small and mid-sized banks hold most of those commercial loans. And if the landlords cannot pay, the banks will take the loss. If the banks take enough losses, they will fail. And if banks fail, credit tightens for everyone. Small businesses, home buyers, and regular consumers like you and me. Right now, lenders are playing a game called extend and pretend. They're giving borrowers a little more time, hoping interest rates will fall and save them. But the one big beautiful bill suggests rates are staying high, and the game ends in 2026. Okay, now before we wrap up this video, pay attention to this one last little piece of information, and it's the valuation warning. Okay, despite all these risks, the debt, the real estate crisis, and the inflation, as well as broken consumers like you and me, the stock market is priced as if nothing can go wrong. And there's something called the CAPE ratio. It measures how expensive stocks are compared to their actual earnings over 10 years. As of late 2025, the CAPE ratio sits at 39.1. The historical average is around 20. The only times in history it's been this high were in 1929 and 1999. Both times were followed by catastrophic crashes that took decades to recover from. The market is priced for perfection. It assumes AI will change the world instantly, and it assumes that the Federal Reserve will cut rates at exactly the right time. It assumes no wars, no shocks, and no problems. But the world is never perfect. There's a basic law of finance. The value of a stock is based on its future cash flows. When interest rates were 0%, future money is worth a lot. When interest rates are 4%, future money is worth much less. The market hasn't adjusted to the new reality. Stock prices are still acting like it's 2021 when money was free. This mathematical mismatch must resolve, and it usually resolves by prices collapsing to meet reality. So now I think I know what you're thinking. People have been predicting crashes for years. Why should you listen to me now? It's true, some people always predict doom, but this time the warnings aren't just coming from random people on YouTube. They're coming from the biggest banks in the world. JP Morgan forecasts a roughly 35% probability of a recession in 2026. Vanguard projects stock returns of only 4 to 5% for the next decade, warning of AI exuberance. These are conservative institutions. When they start sounding the alarm, it's not for clicks. It's because their internal data shows the math just doesn't work. The difference in 2026 is convergence. In previous years, we had one problem at a time. Maybe it was just inflation. Maybe it was just a pandemic. In 2026, we have the corporate maturity wall, the commercial real estate crisis, record margin debt, sticky inflation, AI reality check, and a broken consumer. Any of these could be managed. All of them together create a fragility that cannot be fixed. So what is your survival plan? If the crash is coming, what do you do? Do you sell everything and hide cash under the mattress? No. Panic is not a strategy. Preparation is. So here are 4 steps. 1. Move to quality. Get out now of speculative tech stocks. Move into companies with real cash flow, low debt, and essential products. If the AI bubble bursts, people still need toothpaste, healthcare, and electricity. 2. Buy bonds. With rates higher, government bonds now offer real returns. They act as a hedge. If the stock market crashes, money usually runs to bonds, driving their value up. 3. Buy gold. Central banks are buying gold at record rates. Gold is the only asset that isn't someone else's debt. In a world of debt crisis and geopolitical chaos, gold seems to be insurance. 4. Fix your own balance sheet. This is the most important thing. If you have variable rate debt, pay it off now. If you're trading on margin, stop immediately. In 2026, cash will be king because it'll give you the power to buy assets when they're on sale for pennies on the dollar. So if the crash of 2026 happens, happily, it'll not be the end of the world, but it will be the end of an era. It will be the end of the free money experiment that allowed zombie companies to survive. It'll be the end of winner takes all market where 7 tech stocks hide the rot in the rest of the economy. It'll be painful, but it'll also be necessary. Markets are efficient in the long run. They correct imbalances. And right now we have the greatest imbalance in 80 years. The debt is too high and the prices are too high. Expectations are also through the roof. Gravity always wins. So the numbers don't lie. And right now the numbers are screaming. The question is, will you listen? If you found any value in this video, please share this with someone else. I'll see you in the next one.